Ever wondered how some multinational corporations manage to pay less tax than they seemingly should? Well, it's not some mystical trick. It's tax avoidance. Not to be confused with tax evasion, which is illegal. Tax avoidance involves manipulating the rules to minimize tax liabilities. Enter the world of profit shifting, inversions, and transfer pricing. Profit shifting involves moving profits to countries with lower tax inversions. On the other hand, are when corporations move their legal headquarters to a tax-friendly country. Then we have transfer pricing, a method that involves setting prices for goods and services sold between related entities within an enterprise. It's a complex web of strategies that allows these corporations to minimize their tax liabilities. Let's delve deeper into the most common schemes used by multinational corporations to avoid taxes. One of the most prevalent methods is profit shifting. This strategy involves corporations moving their profits to countries with lower tax rates, effectively shrinking their tax bill. It's a bit like moving your savings to a bank with a higher interest rate. Then there's the tactic known as inversions. This is when a company reincorporates in a country with lower tax rates, a move akin to changing your home address to enjoy a lower cost of living. Lastly, we have transfer pricing. It's a bit like selling goods and services to your own subsidiaries at inflated prices to reduce profits. Imagine selling a pencil to your sibling for £100. These schemes, while legal, raise ethical questions about the responsibility of corporations to contribute to the societies they operate in. So, who's really paying the price for corporate tax avoidance? Well, it's a hefty price tag, borne largely by countries losing out on massive tax revenues. This loss is substantial enough to disrupt economies, creating a burden that's shouldered by individual taxpayers. The ripple effect is a widening gap of social inequality, further straining the fabric of society. Interestingly, it's not just developing nations feeling the burn. Developed countries like the United States and United Kingdom are among those most impacted. The corporate tax avoidance game is globally pervasive, leaving no corner untouched. In essence, multinational corporations dodging their fair share of taxes perpetuates a vicious cycle of inequality and economic instability. Addressing tax avoidance is not just about increasing revenues, it's about creating a fairer society. What can be done to curb tax avoidance by multinational corporations? A harmonized approach is the key. International cooperation can lead to stronger regulations and greater transparency, closing the loopholes that these corporations exploit. Public pressure, too, plays a significant role. By demanding accountability, we can discourage unethical tax practices. Ultimately, it's about making sure corporations contribute equitably to the societies they profit from. Together, we can ensure that multinational corporations pay their fair share and contribute to the societies they profit from.